Ever feel like the market waits for you to exit your option trade before it finally moves? The problem isn't your analysis, it's the Greeks fighting a war most didn't even know existed. A lot of retail traders look at charts, pick a direction, and click buy. They never stop to ask how that option is actually designed to behave. They can spot the right stock setup with the right direction and still lose money. Every contract has a specific set of numbers controlling it, but most are just cruising along, never once glancing at the dashboard. I'll show you the big three numbers that control how every option moves and how to use them so you stop buying contracts that are mathematically stacked against you. Delta, Theta, and Vega. These three Greeks explain why an option is cheap, expensive, fast, slow, or dangerous. Let's get to work. Think of an option like a high performance car. Don't just ask one question, where is the stock going? Start by checking three specific numbers. How fast will this contract respond to a move? How much is it costing me every single day? And what will happen to the price if the market environment shifts? Those three answers are already on your screen, hidden in plain sight on your options chain. Some traders ignore them because they look like complex formulas. They're not, they're just your dashboard. Let's start with the most important number on the board. Delta. Delta does two things. First, the basic definition. If your option has a 0.50 delta, your option gains about $50 for every $1 move in the stock. Simple. But here where delta gets interesting. Delta can also be used as a rough probability. A 0.50 delta option roughly has a 50% chance of finishing in the money. An option contract with 0.25 delta roughly has a 25% chance of finishing in the money. This is where so many make their first mistake. They buy cheap options with tiny delta and hope price explodes. That's not a deal, that's lottery behavior. Same stock, same direction, very different math. You want controlled movement, so stop paying for hope and start paying for probability. Rule number one, when buying calls or puts, the sweet spot for delta is between 0.50 and 0.75. Below 0.50, you're moving away from probability and towards speculation. Above 0.75, you're overpaying for certainty you don't need. That one rule eliminates most bad contracts instantly. Now, let's talk about the silent killer that quietly drains accounts. Theta. Theta is time decay. It's how much value your option loses every single day, whether the price moves or not. Think of theta like fuel consumption. Every day you keep the engine running, it costs you something. Here's what the retail crowd misses. Theta accelerates. 45 days out, decay is slow. 21 days out, it starts to pick up speed. But the weeklies, those burn fuel at a massive rate. That's why they look cheap, but the decay is incredibly expensive. The stock has to move fast and far just to break even by expiration. Remember, if you're buying options, time is working against you. If you're selling options, time is paying you. That is the entire game. Rule number two, when buying options, stay 30 to 45 days out. Pay for time, which gives your thesis room to breathe. When selling, like in credit spreads, look at 7 to 14 days out, because now time decay pays you instead of costing you. Same Greek, opposite side. Finally, the Greek nobody respects, although it discreetly hurts your contracts. Vega. Vega measures how sensitive your option is to volatility, not price. Think of it like insurance pricing. Before earnings or major news, uncertainty rises, implied volatility spikes, and options get expensive. If your Vega is 0.10, the option gains or loses $10 for every 1% move in implied volatility. This is how traders get trapped. They buy a call, the stock goes up, and they still lose money. Because once the news drops, uncertainty disappears and volatility collapses. That's IV crush. If IV drops 10% and your Vega was 0.10, you just lost $100 instantly, even if the stock didn't move an inch. Rule number 3, always check IV percentile. IV percentile above 50, options are expensive. Don't buy, sell spreads. IV below 35, volatility is cheap, buying makes sense. In between, that's the danger zone. If it's not clearly cheap or clearly expensive, don't force a trade. If you must move, use debit spreads. They help offset the high cost while still giving you the exposure you want. We'll dive into a full step-by-step guide on debit spreads in a future episode. Anyways, never buy options when the crowd is panicking. That's when you're paying the worst prices. Here's the checklist. Take a screenshot. 1. What is my delta? Is it between 0.50 and 0.75? 2. What is my theta cost? Do I have enough time for my thesis to work, or is it time to sell it? 3. What is my Vega risk? Am I buying cheap volatility, or am I about to get crushed by expensive insurance? If you can answer those 3, you're no longer guessing, you're trading mechanics. 3 yeses, that's a professional setup. 1 no, skip it. There are thousands of contracts out there. You never need to force a trade. Let's apply this quickly. SPY is trading near 690. You're bullish, but not expecting a huge move. You choose a call with a 0.50 delta, 35 days to expiration, and IV at 35%. Delta gives you solid probability, Theta Decay is manageable, Vega risk is low. That's a clean contract. Now compare that to a cheap weekly with a 0.20 delta and high IV. That contract needs perfection just to survive. Same thesis, completely different outcome. You now understand the dashboard. This is the difference between guessing and knowing why a trade behaves the way it does. Hit that subscribe and like button if the Greeks finally make sense. In the next episode, we're talking about exits. You can have perfect entries, perfect Greeks, and perfect contracts and still give everything back if you don't know when to get out. I'll show you a mechanical exit system that removes emotion completely. Now for the homework. Open your broker, pull up SPY or NVIDIA, compare a 40-day option and a 5-day option. Look at delta, look at theta, then comment below delta, whatever number, is my new standard. See you in the next one. Trade smart.